to Real Estate at Work.
We've got Tom Carroll here, and Tom and I actually met about 5 years ago. So this was before I was with InvestNext, and I was raising capital I was head of investor relations for a group out of Ann Arbor, and I was using a platform that they had testimonials on it, and Tom's name was on there for one of the testimonials. It was kind of funny. So I looked and then reached out to Tom, and we started having a conversation because the company was headquartered in Michigan, but I didn't realize Tom was not actually in Michigan at the time. But so Tom and I got on the phone and just started picking his brain, and then him and I have been in touch ever since. So he started using InvestNext a couple of years ago, like switched from the other portal. But it's been, like a whirlwind of just a ton of knowledge since him and I had started talking. It was, it was just kind of like an instant connection though, but his knowledge of the industry, but also like investments and everything was just mind blowing. So every time I talk to him, I always get a nugget or two that I've learned that's been pretty useful in like helping raise capital or reporting to investors or speaking to investors, or how to try to just kind of like communicate the brand or everything that's going on with projects. So he's been kind of instrumental with that, and kind of like where we've taken InvestNext or certain points. His team's kind of pushed us that way. So it's been amazing. So welcome to the meetup, Tom.
Thank you, Leka. Thank you, Brad. Appreciate it a lot. Very nice to be here this afternoon.
Yeah, good having you. So obviously we can tell you've got a cheeky little accent there.
Indeed.
So from London. So you want to tell us like a little background about where you started?
Sure, absolutely. So I'm originally from London, and I went to the University of Edinburgh, and I have a master's in economics and economic history from Edinburgh. I spent 1 year at UNC Chapel Hill as part of my master's program. When I left, when I graduated, I joined a British bank called HSBC, and the first posting that they put me on was in the US. So I worked on the US trading floor, the interest rate derivatives trading floor eventually, for a bank called HSBC. I was there at HSBC for about 5 years in rates trading, macro trading, and I ended up moving into helping HSBC found their Latin American derivatives team. So they had a large retail presence as a bank throughout Latin America, but they did not have any derivatives capability or kind of complex markets capability. So I helped the team build that out. And because of building that business for HSBC, Goldman Sachs reached out to me in 2006, 2007, and asked me to come to Goldman and help them build their Latin American structured credit business. So I joined Goldman in 2007, which was a remarkably ideal moment to move into structured credit specifically, just prior to the crisis. And I sat in the same desk that helped issue and securitize quite a lot of mortgages and other things. More broadly, though, I was specifically within the Latin American team and helped build the Latin American team. So I was at Goldman for about 9 years, just over 9 years, and started by helping them to build and eventually run their Latin American structured derivatives group. So we did all sorts of funky and interesting things, and then eventually went on to run structured credit trading for Latin America for the back 3 years of my time at Goldman. I left GS in 2016, looking for a more entrepreneurial experience. Goldman is a pretty entrepreneurial place as large institutions go, especially compared to my prior employer, HSBC, which is much more bureaucratic. But at the same time, it's nothing like running your own business. And so I left in 2016, and from 2016 to about 2018, I worked with the group that you mentioned that was based out of Michigan, that focused on workforce multifamily in the Midwest, and then eventually sprung out of that organization into what is now Ballast Rock, which was founded in 2018, and have focused on Ballast Rock ever since then. So what we do at Ballast Rock is we democratize access.
Wait, Tom.
Oh, sorry.
I love that. And I have so much to dive into before we talk about Ballast Rock. First of all, thank you for coming on the show. It is, after talking to you, it's such a pleasure to sit back down and talk to you again, because my brain cells grew so much after our first conversation. So I'm kind of excited to share you with everybody. So you said you had a successful career at Goldman Sachs. You were probably under the golden handcuffs when I switched careers, like midlife, and it was an easy switch for me because I didn't make too much money and I worked way too hard. So like what, empowered you to say, I have this amazing career, like I have, everything I want, but I still want to go out and do something and take that big risk, and like basically start from scratch.
Well, I was fortunate enough to have made quite a lot of money by that point in time. So I was at a position that I could effectively retire.
Yeah.
And so, yeah, I mean, I didn't have a particularly high cost of living. I actually was able to move to my second home and rent out my primary residence in Manhattan. And as a result, really slam my cost of living down. So, it gave me the runway that a lot of startups will talk about. So runway. And I will tell you, I've been doing this. I left Goldman 6 years ago now. And for the first 3 years, I made zero. So to really start from scratch, you do have to have some runway. You either have to live like a monk, and I have a wife with a credit card and two children. So I sadly am not able to live like a monk, but I was able to slam my cost of living down quite a lot to give myself the runway. And I've been fortunate enough, to have been able to be in a position to effectively step back. But I also knew I was 36 years old at the time. Mm-hmm. And I knew that if I didn't do it then, probably wasn't going to do it ever. And I worked on a trading floor at HSBC for about 5 years and then at Goldman for about 9 years. And what you see is there's almost nobody on those floors with gray hair. So, and the people that are on the floor with gray hair are either in a glass office off to the corner somewhere, right? Very, very, very senior, or they're kind of depressing, and it's kind of depressing seeing those people.
They basically made it their life's mission.
Yeah, and they're they're commuting from like Hershey. I knew some guys, they commuted from Hershey, Pennsylvania. They were in their 50s and they were commuting. It was too depressing for me. So I was like, look, I've got a choice. I can either go, take some time out. I needed to take some time out. I actually, because I was covering Latin America, I was traveling to LATAM. I put 2 million miles on my American Airlines account, right? I was traveling every other week. I would do a night in Sao Paulo or a day in Buenos Aires or a day in Santiago de Chile. And it just was ridiculous. I never saw my children. I was absolutely traveling all the time. So I knew I was going to take some time out to be with my kids. That was a big driver. I have young kids, and it was then or it was never. And I had the good fortune to be able to do that. And I wanted something more entrepreneurial. One of the things I did love about my experience at Goldman was it was a pretty entrepreneurial environment. And I was specifically not what's called a line trader. I was not a flow product trader. So everything that I was doing, we had to create from scratch, which effectively meant building a new business every time you do something. So for example, we would do some type of funky cross asset class derivative that had never been done before. Goldman's uniquely flexible in its ability to do things because it's got a centralized database system that's in-house built called SecDB. It's one of the only firms on the street that actually has its own in-house system. And that gives it incredible flexibility to do new and interesting things. But each time you do a new and interesting thing within a big organization, you have to align the compliance team, the accounting team, the legal team, the blah, blah, blah. It turns out, though, that's exactly what it takes to start a business. Right? You need
to. What made you decide to go from that to then real estate? Because that the first move to that.
I had been an investor with this group out of Michigan. And one of the guys I've worked with at HSBC previously was a partner there. And he said, so actually in the first fund, I think I was his largest individual investor. And between myself and just a couple of guys that sat next to me at Goldman on the trading floor, I mean, like on a trading floor, you are sitting shoulder to shoulder with other people. So everybody hears all of your business, whether it's good or bad. And so if you're making, like I was due diligencing this particular investment into a multifamily syndicator, and 3 or 4 other people around me just listened in, and so ended up coming in with me. So this friend of mine and partner at this Michigan-based sponsor said, look, between yourself and a few friends of yours, you were 1/3 of the equity of our first fund. Why don't you're not doing anything. Why don't you come on board and help us kind of mix this up a little bit? So I did. I joined them, and I ended up raising about $80 million for them over the next couple of years for their Midwest funds, and helping them refine strategy and things like that. But at the end of the day, it was more interesting for me to go my own way and build something that was beyond just real estate. Real estate is the core of what we do at Ballast Rock, but it is one of a series of sleeves of different investment opportunities that we offer to our investors.
That's awesome. I would love to hear from you on how you structure the company today.
Sure. So today, actually, and as with everything, we're constantly growing and changing. But today, we have 3 core sleeves of investments that are offered to our investors. All of our investors do need to be accredited, but that's an achievable bar for many people. And yet we're able to offer really interesting opportunities, unique access that historically was not available to anyone but the ultra high net worth or institutional investors. So the first sleeve that we have is our real estate sleeve, and that is focused on workforce multifamily in the Southeast. We acquire it, we operate it. So we have in-house property management. We do everything soup to nuts in-house. Now, because I ran teams at banks, and because I'm Series 24, I was able to go out and hang my license, and therefore do distribution of third-party products. So beyond just the funds that we raise for our own real estate funds, we've actually been able to go out and identify what we believe to be best-in-class partners for different other segments of investable assets. So one is venture capital. We spent a lot of time due diligencing different VC partners, and we identified a group called Acronym Venture Capital that we have just completed the raise of one of their funds. And we're actually tightening that partnership, and we're going to be launching another fund with them soon. They have a very similar investment philosophy to the way that we invest at Ballast Rock on the real estate side, but just they apply it to venture cap. And so that's one group that we partnered with. So the 2 sleeves.
Where is Acronym based out of?
Acronym are based out of New York and Florida.
All right.
So they're kind of across the East Coast, but and they have very much like an East Coast venture capital investing strategy and philosophy, which I was not. I have invested in venture over the years. I've done 6 or so VC investments myself personally, but I felt that personally I didn't have the experience or deal access. I mean, all of you guys are real estate investors, and hopefully you've realized this is a private market that you're investing in. And if you don't have adequate deal access, you're not seeing what's going on in the market, and therefore you're more likely to get your face ripped off, as they say, right? So to use an industry expression. If you, with any private market, real estate, a lot of, venture cap, any private market, you really have to be working with somebody that has a massive amount of deal access. And so in real estate, we do that. For example, we've underwritten about 1,000 multifamily workforce housing deals in the Southeast over the last 3 years. We're underwriting 2-3 deals every single day. I have some extremely talented but very unfortunate guys that have to sit in Atlanta and just underwrite deals all day for me. That used to be me, so I definitely feel their pain. But they're really good at what they do, and they just crank out deals. But that's really the only way you know what's going on in the market. You have to know, how are cap rates moving because rates are moving? How are cap rates moving because of an influx of fresh capital at this point in time or in this market, and so on and so forth. So having a pulse on the market, the only way to do it is to see a lot of deals. So in venture cap, we partnered with the Acronym team because, like us in real estate, they have massive deal access. They're looking at something like 5,000 deals a year and underwriting about 5,000 deals a year. So that's our venture sleeve. And then our final sleeve is our environmentally positive sleeve. And right now we're partnered with a group called Strategic Biofuels that are building a synthetic diesel plant manufacturing facility in Northeast Louisiana called Louisiana Green Fuels. So you can look that up on our website. We have some really handy little videos, just 3-minute videos about that project. But it's another absolutely fascinating project.
Okay, so that's super impressive because most multifamily syndicators that not most, like 99% of people that I speak with have just done multifamily. So like, why did you venture out into these other segments? And then how did you pick these to be your segments?
Good question. I mean, ultimately, I'm embarrassed to admit I'm not really a real estate guy, right? I'm a derivatives trader by training. So I spent 15 years learning how to price anything. So what you learn in structured credit or in structured derivatives is how to price stuff.
Yeah.
I mean, everything from longevity and mortality, which is like when people die, to weather derivatives, to, for example, when I first got to Goldman, they just securitized, and we were in charge of distributing the risk of the Channel Tunnel, which is the tunnel that goes between France and England. So, I mean, there are all sorts of crazy risks out there that get chopped and changed by professional traders all the time. And that's exactly what my job was. So, so I think what I brought to real estate was an understanding of risk, an understanding of the importance of managing risk, and an understanding of trading in illiquid assets. So I traded quite a lot of LATAM bonds, looked at a lot of LATAM bonds. And Latin American bonds often, especially corporate bonds, are exceptionally illiquid. And so you really have to have an understanding of how to trade any type of illiquid assets, of which real estate is one of them. So really, real estate was just a springboard. From real estate and from the 3 things we deliver to investors, which is performance, communication, and access to the management team. By delivering those 3 things to investors in real estate, we were able to build a massive investor base. We have about 1,200 active investors. And so those investors kind of helped us drive what we were going to do next. They said, like, guys, we love what you're doing in real estate, but you can only deploy so much capital so rapidly. One thing, as you start to scale a business, and we've now deployed 160 million of total investor equity just in real estate. And then in total, I've raised about 200 million over the last few years. The rest has been deployed into other asset classes like venture capital, like Louisiana Green Fuels, et cetera, et cetera. But just in real estate, to deploy that kind of money safely, carefully, thoughtfully takes time, right? I mean, you guys were just talking, I think Josh was just commenting on an acquisition that he's making and how time consuming that is, and that it's going to be delayed and yada, yada. Guess what? It doesn't get better as you do bigger. It's just as complicated, if not more so. And it's just as hairy, and there's just as much due diligence and so on and so forth. So it's time consuming. So ultimately, I mean, I give this example. If somebody comes to me and says, here's $1 billion, deploy it, I would say, no, thank you.
No, thank you. I know.
Can't take it. We just can't deploy it quickly enough. We are oversubscribed for all of our funds in real estate, all of them. So it's not a matter of the equity capital. It's a matter of being able to safely, be a fiduciary for your clients, for your investors, and safely and carefully deploying that in deals that hit the quantitative and qualitative criteria that we need. And those deals are few and far between.
I am so
How do you get to
Sorry, Brad. I am so glad that Tom said that, because Simon just asked me before we started this call why I don't want to scale and grow my company even larger than it is today. And it's because that's a lot of responsibility. I do have access to unlimited capital, but with great power comes great responsibilities. And so I just, at some point I'm like, I don't want all that responsibility. Like, I just want to live life a little. So thank you for saying that, because that's like the most important thing when you're dealing with not your own money, but other people's retirement accounts and savings and life's work. Sorry.
Absolutely.
Go ahead,
No,
Brad.
absolutely. And to that end, the way that we continue to scale is by hiring fantastic talent.
Right.
So, Ballast Rock is not me at all. We've got about 15 corporate staff, 16 corporate staff, and we're expanding. We'll be more like 20 by the end of the year, just at the corporate level. Then we've got about 85 operational staff. So that's property managers, maintenance teams, leasing agents, et cetera, et cetera. It takes time to scale a business. And one of the big things that I've learned, arguably the hard way, because when I started, the prior sponsor that I worked with focused on using third-party property managers. And one of the things we learned the hard way is that that's just not as functional. They're not properly aligned with your interests necessarily as an owner. So we scaled our own property management business from scratch. But that takes a lot of time. And so what you learn is that real estate, despite being a very capital intensive business, depending on the type of real estate, but certainly multifamily, is really an operating business. So it's not just, so it really is about the quality of your operating team that can make or break your ability to hit your pro forma.
How important do you think that was to like ramping from the Michigan group to Ballast, like the third party, getting rid of that and then having your own property management?
Massively important. And I give full credit to Danielle Miner, who I brought in 2018. So she started from the beginning of Ballast Rock, and she is the CEO of Sunbelt Properties, which is our in-house property management division. They don't do any third-party management. They just manage our assets. But she is a phenomenal talent. She spent 13 years in the Army. She was a military police officer. She spent 5 years or 6 years, I think, in the Denver police force. And then she was retired due to a service injury. She then started her own property management business. She grew it from 0 up to about 800 units. And from there, she then sold it to a local competitor. I happened to meet her at like a similar meetup to this, though not online at the time. It was all in live and living color. Anyway, I managed to tell her she was very, very proud of her 800 units under management, which she should be proud of. That's remarkable. But she must have had, I don't know, not 800, but probably 200 or 300 different landlords that she needed to deal with. And so I said, look, you got a choice. You can go back and do it all again, except that you've got competition restrictions. So you'll have to go to a different market, blah, blah, blah. Alternatively, come on board with me. You'll only ever deal with one landlord, right? And I'll give you 8,000 units within 8 years. So she's like, all right, well, whatever, this idiot, I'll get involved. So she did, and from scratch, she's built this business along with other senior team members. She didn't do it alone, but I give huge credit to her for having built that business and what she's achieved. She's a phenomenal talent at managing human capital. So I'm experienced at managing like a team at Goldman, a bunch of overpaid guys that think they're way smarter than they really are. But I know exactly how to compensate them and motivate them. But she's extremely talented at managing a totally different type of person, right? It's very different managing property managers, leasing agents, maintenance crews than a bunch of overpaid Wall Street guys. Like that's, it's quite a different skill set. So I'm very grateful to her and her kind of human capital management. Yes, she can kick in a door if she needs to, but really her skill set is that human capital management.
How far is the geographic region that division covers, and are all your portfolio? Is it all across the nation, or is it
so Ballast Rock only invests in the Southeast. We're North Carolina, South Carolina, Georgia. We have some assets in Eastern Alabama. We're looking at assets, but we don't currently have anything in Eastern Tennessee, in North Florida. Now, I will also say that the Sunbelt property management team did such a good job that we actually went back for the partnership that I was still a member of, the Michigan partnership. We went back and we fired all the third-party managers, and we hired Danielle and the Sunbelt team to go back and fix, fix the property management issues with third parties. So she's managed assets in Michigan and Ohio as well.
That's amazing. And how did you pick your multifamily strategy? Why workforce housing?
So that was a macroeconomic analysis. So there's ultimately, as with anything, it's about supply and demand. Right. Workforce multifamily, there is an ever-growing demand for affordable housing, or affordable is, certainly affordable, both capital A and lowercase a, right? Like affordable capital A meaning government supported housing, but lowercase a meaning just stuff that's affordable, or what in the industry is often called attainable housing. So because affordable actually means like LIHTC, low income housing tax credits, or other kind of government supported housing. When we talk about affordable, we're really just talking about what's called market rate housing or attainable housing. So there's an ever increasing demand for attainable housing. And there is not only no increasing supply, but there's actually diminishing supply. Because of course, older buildings are knocked down in order to build new buildings. And because of the cost of construction, nobody's building workforce housing. They're building luxury housing. And eventually it rolls down the curve, either because the neighborhood changes or something changes. But really, that's really the only way that workforce housing is created. A neighborhood has to change, a building has to deteriorate, and it just has to get old. And that's how workforce housing is created nowadays. I mean, there is a whole LIHTC market, low income housing tax credit market, which I don't know, Leka, if you've spent any time looking at that market, but it's a very challenging market to get into if you're not a developer that's been very active in that market for a long time. And the amount of tax credits that are available, certainly what are called 9% credits, is extremely restricted. It's done on, it's kind of an old boy network, very difficult to crack into. So really there's just no additional supply. A lot of incremental demand, and anytime you've got a lot of demand and not a lot of supply, that's a market that I want to be long. So that was it, really.
That's a great strategy, is to look at the macroeconomics and see where it is that you can, what strategy you really can take advantage of. So my team and I, we just closed on our first apartment syndication. I won't say that it's low income, but I would say it's workforce multifamily sort of, because it's still in a higher end suburb of Seattle, but it's more geared towards workforce segment of population. So I'm kind of there, but not quite.
Well, you're in Seattle, so nothing's affordable in Seattle.
Exactly. That's why I was like, it's not technically low income affordable, but I mean, kind of is.
Our average rents across our portfolio are like $850 a month. I don't know what that would buy you in Seattle, but probably not much. A bed somewhere. A bed that you can only sleep in 6 hours a day, something like that.
My asset manager Travis is on here, and he's like vigorously shaking his head. He's like, no way, nothing.
Yeah, right. So it does buy something affordable. And actually, I joke, but so the driver for us getting into workforce was two things. One, it was we believed that there was market, there was upside, there was potential to make money. And two, on the Ballast Rock side and having in-house property management, we can genuinely make a positive social impact in workforce housing. I can't do that in luxury apartments, right? Like if I better operate your Manhattan apartment, white glove Manhattan apartment, it's just a question of how good the bagels are that your yuppies get in the morning, right? Really, operationally, it makes no difference to the greater scheme of things. But in our properties, in our communities across the Southeast, we're able to genuinely improve security, genuinely improve quality of life, genuinely, make a significant difference, create a sense of community. And that positive social impact is important to us as an organization. In fact, a little plug, but we are actually about to set up the Ballast Rock Foundation, which is set up to help alleviate housing insecurity in the Southeast. So, you know, we're the social impact component is important. I have, you know, worked on Wall Street for 15 years. I think I probably need to give a little bit back. And we felt that workforce housing was an achievable way to do that. So an achievable way to have positive social impact, genuinely create a better quality of life for our residents through better operation and through actual cash investment. We're typically investing 10 to 15% of our acquisition price in any property that we purchase. So it's significant. You know, you're buying a $10 million property, you're investing $1 to $1.5 million in everything that we buy, for example.
I know you mentioned social, and you also have touched on venture and how you got into that because you'd invested in it before. But how did you get into the stuff like ESG, like the Louisiana Greenfields? How do you go from that and then present that to your investor base of like, hey, we've done real estate. Now I'm getting in venture, but I've got this ESG deal in Louisiana. So how did that all take place?
Sure. Well, so actually, I brought on a colleague about 2 years ago that had somewhat similar experience to me. He'd spent about 20 years in the City of London, which is the kind of European equivalent of Wall Street. So he spent about 20 years in the city working in different sales and trading roles on some very large banks like Morgan Stanley and things like that. And so, you know, again, another professional investor by training. He joined me about 2 years ago at Ballast Rock, and we spent 6 or 12 months looking at a variety of different projects. As he likes to put it, like a moth to the flame. When you raise capital, and Leka, you probably see the same thing. When you raise capital, and I raised quite a lot of capital, a lot of wonderful and wacky things come across your desk, right? You know, most of it is nonsense, but some of it is interesting. And so, so we had this situation where we had a massive investor base that was actually asking for product, good product, attractive risk-adjusted return product. And at the same time, I see a lot of deals, especially in the Southeast, come across my desk. So we paired these things together. And actually, one of the core focuses since the beginning has been our positive social impact. So we know that it's important to our investors that we're able to have a positive impact. And so actually, through a kind of weird connection, this Louisiana Greenfields project came across my desk. I ended up investing actually as an individual well in advance of bringing it to our broader investor base. We spent, my colleague and I spent many, many months diligencing it before I invested. And then I invested, my family invested, some of our kind of closely held entities invested. And then we ended up bringing it to our larger investor base. And since then have raised about $25 million for that project and are in the midst of actually doing the institutional capital raise, which should be around 900 million over the next 12 months. So one of the beauties of my organization is not only do we have a massive retail investor base, but we also are institutional traders and salespeople by training. And so we have a very sizable Rolodex of institutional investors. So we're able to, with the Louisiana Greenfields project, we've been able to take a project that was at too early a stage for institutional capital, with retail capital, bring it to a stage that it is now in the midst of negotiating institutional capital as we speak. And now it will be institutional capital only going forward. So that's a unique situation, especially in what's called energy transition, the transition away from fossil fuels towards more renewable fuels, of which this Louisiana Green Fuels project is a critical part of that energy transition path that the global economy needs to make, in particular here in the US needs to make. So, so anyway, we're incredibly excited about this project. We've been able to, as I said, we've been working on it now for almost 2 years. We've been able to bring it from early stage to now not so early stage at all. In fact, we're now in negotiation with guys that will be giving institutional investors that will be giving the construction financing for it. But the path, Brad, was you got the investor base, they're asking for something, you find the deals, and you bring them together really. And it was extremely well received. So we actually were mandated by Louisiana Green Fuels to raise 8 to 10 million. And last year we ended up raising 15.2, 15.5 million. And actually we got capped out. We had a limit on the number of investors, 100 investors in total that we could have in the fund. We got capped out at 100, just shy. I think we stopped at 99 just to be safe. And it's a limit that was that's an SEC limit in order to utilize a specific exemption to the Investment Companies Act. So we got capped out with that limit, but we also, beyond we were almost 1.5 times what our mandate had been. We got capped out, and we had more demand behind that. So we then turned around this year, asked for a further mandate from Louisiana Green Fuels, which they gave to us, and we've now almost filled that further mandate for this specific project. But this project is very much like a real estate development project that right. Many people here, that you yourself, Leka, have done.
So I think one thing that would be super beneficial, but we won't talk about it now. We're going to make everybody stay till the end, is to talk about your skills at capital raising. I think everybody needs capital to do deals, and you seem to do that effortlessly. So we're going to talk about that.
I wish I could say it was effortless. That's not true. It's a heck of a lot of
make
work.
It sound like it. That's why it would be really cool to get your perspective on that, because I think there's a lot of money available today, but it's like, how do you channel that and use that to the advantage of just growing your own business, scaling, all that good stuff? That would be super amazing.
I will keep my lips sealed until the end of the conversation.
Exactly right. Okay, so you said that you have your own property management company. I know that you also do an amazing job with reporting, and once you are at that scale where you have like thousands of investors, how did you build out your reporting structure? Because that's done in-house too.
Yes, good question. So actually, we've always had a really heavy focus on reporting. And as you scale your business, as you have more and more investors, just managing your existing investor base becomes a full-time job. And so if you have one full-time job of running the business, it is detrimental to the business to have two full-time jobs, one running the business, one just managing existing investors. So the best way to handle those existing investors is to cut them off at the pass. So how do you cut them off the pass? By great reporting. The more that you report, the more information that you give to investors, the greater confidence they have in what you're doing, and the less questions they ask. And I love questions. But at the end of the day, with 1,200 investors, and they all have my cell phone, right? So I mean, there's a limit to the number of hours in the day. And so, we've really focused on that extremely high level of reporting. So, for example, what does that mean? Our asset management team report on a monthly basis. Our financial team, our CFO, financial controllers, report on a quarterly basis on top of that. So we're doing very in-depth reporting, both monthly and quarterly. And then, of course, our auditors report on an annual basis. So the financial data is there. We also do listen to our investors. And so if they say, you know what, like, I'd love it if you could do this a little differently or that a little differently, if it makes sense, then we certainly implement that. And the way that we've been able to do that high quality of reporting, when we started out, we've made not hundreds, but we've made more than 100 acquisitions over the years and dispositions. So you're talking about hundreds of LLC, or not, I keep saying hundreds, but I mean more than 100 LLCs. Each one of them has their own balance sheet, own income statement, own everything. And so therefore, how do you get this huge number of effectively subsidiaries to roll up from an accounting perspective on a real-time basis? Well, the additional challenge is if you have multiple property managers, And every property manager has their own software, right? Yardi, Rent Manager, Appfolio, everybody's got something different. Right. So how do you actually aggregate, normalize, and roll up that data? And that was the big challenge for us. So if you use one property manager with one system, it's okay. Most of these systems, Yardi, Appfolio, Rent Manager, they all have reasonable reporting quality. But when you start going cross-manager, that becomes much more challenging. So we went out, we looked for software about 5-6 years ago. We couldn't find anything, so we built our own. That software is called RealPM. Actually, you can look us up, I think, on realpm.io. And we used it, and we only use it internally at the moment, though at some point in the not too distant future, I'm sure it will go and be used more broadly. But we built that to do that data aggregation, data normalization, and enable reporting. And that has been a game changer for us. We could actually report real time. Now, the data on a real-time basis, because it's real estate, wouldn't be that relevant, right? So we don't report real time, we report monthly, but actually our systems and our data management is capable. It uses APIs to pull from multiple different systems, aggregate, normalize, and then publish. And we publish using Power BI on our website. So actually, if you go to ballastrock.com, and then you click on one of our updates, so like updates for Sunbelt Fund 1 or updates for Sunbelt Fund 2, we make our reporting public. So not many syndicators that I know of report on a public basis.
Why do you do that?
Transparency.
Is that from like Goldman training days or like prior investments?
Having a centralized database that's in-house, that's flexible, definitely is something that I learned at Goldman, right? Goldman is much more flexible than the other banks because it has its own system. Not that I'm comparing our system to theirs. Theirs is unbelievably complex and sophisticated. Ours is not anywhere near as complicated, but still it and does one specific thing and one thing only. But having that backbone, that data backbone, was something that definitely came from my GS experience. But it is ultimately just about transparency, and also I will say one of the things that inspired the way that we report at Ballast Rock, and even previously at the prior partnership in the Midwest that I worked for, or worked with, one of the things that inspired me was my venture capital investing experience. So I've invested in 6 VC deals over the last 10 years, typically at an angel or a seed stage, so relatively early. And some of them a couple of them have gone to zero. A couple of them are still outstanding, and a couple of them actually exited, one at a 5x, one at an 8x. So fantastic overall performance. I've done better in that than I have in the S&P. Don't tell me, let's not even talk about what's happened in the S&P over the last few days. I know, super painful. But
in my crypto portfolio, which was very low anyway, but it's gotten
you're a gambling man, Brad. I respect that. But anyway, my experience in VC, one of the things, somebody would have a great idea or they'd be a great team, but I hated that once you gave them your money, your reporting, the information that you received was nothing. Maybe once a year you might get a letter. You'd have no financial reporting, no, and beyond just financial reporting, just nothing, and no access, no communication, nothing. Now, I definitely acknowledge VC is quite different. The way that small, like tech startup companies should report is going to be different to the way that we report in real estate, right? Because we have a lot more data. We have, there's a lot more going on for us to report on. But at the same time, I found it extremely frustrating that, like, one company I invested in, I thought they'd gone to zero, but then like on a Thursday, they said, hey, we ate X and we just exited. we're like, what, you didn't even, I haven't spoken to you for 5 years. What's going on? So like for 5 years, there was no reporting, and then they just exited. I'm not going to complain, but it's a little ridiculous, right? There has to be a middle ground where there can be solid reporting, good communication, and where you as an investor, if you have a question, send an email and expect an answer. It's not unreasonable. So that really has been the inspiration for how we've reported and then built the systems that enabled us to do that reporting.
So you've done real estate, obviously, venture capital, you touched on ESG. What's next? So obviously you're going to probably continue to grow those aspects, but is there anything else that you see this company are moving towards?
Yeah, so we're actually in the process of setting up a private wealth manager, what's called an RIA, a registered investment advisor. And so that'll be called Ballast Rock Private Wealth. And the goal of Ballast Rock Private Wealth is to offer investors the family office type investing experience. So the investing experience of the ultra high net worth individual and their family office. What does that really mean? Well, that means obviously high quality of service, but a combination of a heavier focus on private asset investing. So if most family offices that are out there, so we're talking about family offices of 50 plus million, the amount of liquid asset investing that they do as a proportion is relatively low compared to if you call up your Charles Schwab or Fidelity broker, they're going to tell you 80-20 bonds, or bonds and equity, 60-40 bonds and equity, whatever nonsense that you've just gotten smoked on over the last month. Whereas in practice, the way that wealthy individuals invest is a much heavier focus on things like real estate, on things like venture capital, on things like private equity, the things that Ballast Rock actually specialize in. We're operators in these different areas. And so, our goal, and we're bringing in a totally independent team, so it won't be me personally, it will be a team that we're bringing in of experienced investment advisors and actually of one of the CIO will be somebody that I used to work with at Goldman. In fact, he was more senior than me at Goldman, not directly my boss, but effectively one of my bosses while I was there, coming in as CIO. So, we're going to combine that liquid asset management strategy, a human being overseeing asset allocation in your liquid assets with a heavier focus on private market investing. And it is about providing high quality advice. It's about providing access to things that normally aren't accessible. And I would say curated access to unique assets that haven't historically been available to individual investors, and that, in our opinion, offer a far better risk-adjusted return than just sticking your money in the S&P, which I'm betting almost everybody on this call agrees with, because you're all real estate investors, right?
I think that's interesting too, because I think everyone's battling this, and we see it. You probably see it on a day-to-day basis. Your investor or potential investor takes your deal to their financial advisor, who their financial advisor gets paid for whatever assets they're managing. So they're not going to tell them that this real estate transaction is a good deal or this ESG transaction is a good deal, because they're losing that money. They're not getting paid for that. So once it leaves that, so to have it in one spot, I mean, they're always saying, "No, that's not good," or "This is the risk is," you very rarely see someone take it to one of their financial advisors and say, "Oh, that's a great deal." Either they don't know about it, or the funds are leaving them and they're going to lose money off of that. I'm sure everyone here has had to fight that battle. So it's crazy. You see it happen all the time.
And that's one of the things that we're able to do, right? So we're operators. We know exactly where somebody would hide fees on a real estate deal. Not that we've hidden fees, but that we know where and how one would do that, because we're operating in this sector. Same thing for private equity, same thing for venture capital, same thing for ESG. So we know how it's done, and we have a team that can advise the RIA team and the independent investment committee of the RIA, which will again be independent, on how to analyze deals. And so therefore, like if one of our RIA clients brings us some unique opportunity, we can help analyze that opportunity on behalf of the investor. And then over time, it'll be part of their AUM under our platform. And of course, we'll charge a small fee for that. But we're able to bring all of our team's knowledge, all of that corporate team's knowledge to our investors, give them real advice across their portfolio, including especially their real estate portfolio, and help with that. I will give you a brief and rather funny anecdote. We were having a discussion actually today with a potential investor in the Louisiana Greenfields project, and or actually I think it was yesterday evening, and they fired our project over to their independent RIA. And their RIA's comments for the Louisiana Greenfields project, which is a extremely positive environmental impact direct investment project, their RIA's suggestion was it's a very high risk project, which is true. There's definitely risk in this project, but we can talk about what that risk is. But anyway, very, very high risk project. And I think you're better off if you invest in Shell or Chevron as an ESG investment. If you're recommending Shell, Chevron, or another oil major as an ESG investment, don't get me wrong, I know they're all trying to change their image, and they are doing a lot of positive environmental investments, but they're fundamentally just oil majors, right? Like that cannot possibly be your best recommendation of an ESG investment in this environment. That is ludicrous. You need to,
and that's all that's in their portfolio that they're getting paid on is essentially what it is. You know, it's like
because it's an exchange traded liquid security that they can charge fees on, right? So that's exactly what we're trying to combat at Ballast Rock Private Wealth. You know, we want to be able to offer our investors not only our own products, which we will not be charging fees on. So there's no doubling of fees on Ballast Rock products, but our investment committee at the Private Wealth is independent and will have to approve every one of our funds that's ever distributed through our own network. So it's not a blank check to our own funds. But anyway, so from a growth perspective, we're splitting off. We're having our asset management division, which will continue to have our venture funds. We'll continue to have our real estate funds, our Sunbelt funds. We will have our private wealth asset management. And then one of the other things we're really focused on, I foresee, is that as soon as we finish this Louisiana Greenfields project, we are going to go out and find other equivalent energy transition projects like strategic biofuels, like Louisiana Greenfields. It's going to be very difficult to replicate the level of talent that they have at Strategic Biofuels. They are truly a unique and amazing team. But I'm sure there are other projects out there like that, whether it's in solar, hydro, or other energy transition space. And we will be building and delivering those products for our investors over the years to come. But that is really a multi-year strategy. This year, though, we will be launching Ballast Rock Private Wealth.
I'm so excited for that, and just all the stuff that you put out, because it's so different from what's available to everyone. A lot of investors come to me about, who they should invest with, different operators, and yours is one that I want to highly recommend because it's so unique. And you have this whole mentality of wanting to give back, which is massive. Because everybody's so focused on building wealth that, it's very rarely that you see people focused on also wanting to give back at the same time.
I appreciate that. And our focus, as you point out, we're not a charity, but we are actually setting up a charity, but that's separate. But, Ballast Rock and our Sunbelt funds are definitely not a charity. But as one of my investors put it, They said, I want to build wealth, but I don't want to build it off the back of someone less fortunate than me.
Right.
And we believe that it's very possible to do that, that we can make money. Again, that doesn't mean that we don't use the tools that landlords have to use, right? Like things like evictions, right? Nobody likes to use evictions, but it is an important tool that as a landlord we have to use. However, there are other things that we are doing already and that we are just about to roll out that will really enable us to quantify the amount of positive social impact that we're able to have. An example is we are currently working on a partnership with an incredible company called Isuzu, and Isuzu enable us to do positive rent reporting. So normally, many of us that own homes have mortgages, are already building our credit scores with our mortgage payments. But if you're a renter, you don't, by definition, get to build your credit scores. And so we're often talking about residents that might have credit scores in the 500s or 600s. And so if we can help them with every payment they make to build their credit score, that reduces their cost of capital, right? Because it gets them better quality credit cards, gets them better quality loans, it allows them to buy their own homes eventually, so on and so forth. There's a huge amount of value to that. So we're already doing, we already do positive credit score reporting with one of the three agencies, but Isuzu will enable us to do it with 3 of the 3 agencies. So that's a big step forward, and also to quantify, monitor, and see exactly how much we've helped our residents move their credit scores. You know, are we moving them by 50, by 100 points over what period of time? So that data managing. And then they also have a really exciting loan program that actually our foundation will be partnering with them to be one of the grantors to that loan program. And that loan program enables residents, not just not at our buildings, actually, it's kind of elsewhere, but across the Southeast, to borrow money if they're hard up for a short period of time. And so they give 0 interest loans.
That's crazy. I want to do a quick shout out to my brother Nick's here, and his fiance worked at Goldman Sachs for the last 10, 12 years. So she's completely enamored by you, but she won't turn her camera on because she's incredibly shy. So I said I'll just put her on the spot anyway, because that's the kind of person I am. I just like to do that to people.
Fantastic.
And then Brad here has to step out now, but so I was going to say, Brad, you can say goodbye.
Yeah, good chatting with you, Leka. Good chatting you. Obviously, Tom. It's always a pleasure.
Always
I got
a pleasure,
my
Brad.
brother's birthday. I'm holding up the party like I normally do. But
you're worth waiting for, Brad. You're worth waiting for.
Thank you. But appreciate everything, Tom and Leka.
Thanks,
obviously,
Brad.
thank you so much for everything. Yeah.
And secretly, we were waiting for Brad to leave so then we can talk about capital raising and the cool stuff we're going to talk and market economics, right?
Happy to.
Yeah.
And talk bad about Brad, of course.
And talk bad about Brad, of course. My favorite pastime.
Thanks, Brad.
All right, see you guys.
Thanks, Brad. All right, so let's talk about that capital raising. I wasn't lying. You know, what has been, I think, some of your like biggest strengths, aha moments, advantages to capital raising?
So first, like everybody, I started with friends and family.
Okay.
Now, I happen to be fortunate in that I worked for 15 years on Wall Street on a trading floor. The trading floor that I worked on had 600 people on it, and I used to rotate around the floor because that's how trading floors work. They move you every like couple of months. So I've sat next to, like literally sat next to probably 300 people in my career. So not because I moved jobs, I never moved jobs. I moved once from one bank to another, but just because of the nature of how trading floors work, they really cycle you around. They're constantly moving people, yada, yada, yada. So I happen to have a massive Rolodex to begin with. So I had a big advantage. I'll admit that. I had a big advantage. But from that advantage, the way that I've raised capital is to start with the people that you know, right? And ideally, for me, it was people that I'd worked with. I knew they were wealthy, and I knew that, but I also knew that they knew me and the way that I worked, right? Not just that I'm a nice guy, but that I'd actually sat next to them and worked next to them for a long period of time. So I started with my ex-work colleagues, and then really it was just about grinding it out, right? Highly responsive. One other trick I learned at Goldman is if you don't respond to somebody quickly at GS, they'll cut you out of the email chain. They'll put somebody else into the email chain and you're out of the deal. Like, so I have guys that had a pager that had a 3-minute warning if they got an email, if they needed to respond within 3 minutes. That's a little bit extreme, but it is a place of serious communication. I mean, they drill into you how important communication is, and hopefully I've taken some of that forward into what we've done at Ballast Rock. But high level of communication, right? Answering every question that was ever posted to me, or at least trying, being responsive, taking the time. I have 1,200 investors, and I think I've had something like 1,400, so 1,400 calls, meetings, video conferences. I don't do a lot of big conferences. I do a lot of one-on-one. And really the way that we've grown our investor base has been organic. If you do right by somebody, people get very excited. You know, if you're energized about what you're doing, which I am, and animated about it, then I think that animation and energy gets passed on. And so there's a component of that. But it's mostly just been grinding it out, and it's been organic growth, and it's been being patient. I'll admit we did raise money extremely quickly, especially the first 80 million was like, well, sorry, the first 5 million was brutal, really, really hard to raise. And then the next 75 million was just like a flood. Right. So it is, once you get past a point, then it starts to really roll. And now, like, I have reservations on funds that aren't even open yet. You know, I have people saying, I want in on your fund. The fund's not even open. There's nothing for you to be in on. So, you know, it does definitely snowball when you build performance, credibility, communication. I talk about something called the trust hump, right? You need to get somebody over that hump of trusting you. But once you've gotten them over that hump of trusting you, then if you perform for them, they will be your cheerleaders. They will go out and they get excited, especially when you start talking about unique things like this Louisiana Greenfields project. We've got a couple of cheerleaders that have just gone out to all of their network and been like, I know a guy and he's got something special and unique. And they get very excited about it, and we love it. I mean, that's how we grow. So there's not really magic to it. There's no special sauce. It's just a lot of work. It's a lot of, like, you know, we have investors in Asia, we have investors in Europe, we have most of our investors in the US, and our foreign investors are generally like US tax residents or whatever, but they just live abroad. Yeah. But that means we're communicating. Like, I'll have a call at 7 a.m. in the morning with a guy in Singapore that loves to talk, and then a call at 7 p.m. at night with a guy in Hong Kong that also loves to talk, or a guy in California that love him to death, but cannot have a phone call of less than an hour and a half, right? But it's just being there, pounding the phones, meeting people, answering questions, and building credibility over a long period of time.
I just love that. Like, building credibility, I think, goes a really long way. And I try to do that because, just like you, Tom, I have so many investors and I do want to touch them, talk to them at every chance that I can get, but I obviously don't have the time to. One of them is actually on this call. And what she did was she came out to one of the properties that I was flipping. She met me and my whole family was here visiting, and she met all of them. And like, that builds massive credibility. And she then went on to start flipping her own homes, and she's killing it. She's an absolute stud. But she, you know, invested in one of my first funds when I didn't know what I was doing. But like, having people like her, like, you know, have their confidence in me, wants me to kill it and really, you know, take my business to the next level so I can keep offering amazing deals and opportunities to people like her. And just showing her that, you know, there is a way forward, there's a way to scale, there's a way to grow, as long as you have your heart in it and you have so much energy going into it. So I just love that you said that. And to my investor that's on this call, I love you so much. All right. So I want to also get your thoughts, and we'll make this super quick, but your thoughts on basically what's happening with the market today. So just, moving forward, is there a recession coming? Everybody's talking about an upcoming recession.
Well, are we in a recession is the better
question. Are we in a recession? Yeah. What are your thoughts on that?
I mean, we've had 1 quarter of down GDP growth. The definition of a recession is 2 quarters of negative GDP growth. So we may well be in a recession right now. Unclear. And if we are in a recession, it doesn't mean we all have to panic. Recessions come and go. And it's a question of the depth of the recession. At the end of the day, we're running at like effectively full employment here in the US. So it's not an employment issue. In fact, if you've tried employing anybody recently, it's really hard. You'd think, good luck. And the employees that you do have keep asking you for a raise. So it's definitely an employment challenge. So this is not an employment-led recession, which is a good thing because those are particularly difficult to deal with. But obviously, we're in a high inflationary environment. Now, the question is what of that inflation is temporary and simply COVID supply chain related? And then, of course, we had COVID supply chain, and then Russia invades Ukraine, which is obviously a humanitarian disaster, but also amplifies the inflationary scenario that we're already under at the worst possible time. And then the Fed comes in to tighten up liquidity to try and stem inflation, both in the short end of the curve by forecasting, raising rates, but also raising short-term rates, but also forecasting rates. And then, the question is what they do in the long end of the curve and how they manage that. But I certainly don't have a crystal ball. What we do to manage for our investors, and I'm sure it's the same thing that many of the real estate professionals on this call, on this meetup, will do also. But the way that we combat a rising rate environment, at the end of the day, we're in an inflation-adjusted asset, right? We have short-term leases, as in 12 months resetting leases, as opposed to a commercial real estate, which might have a 20-year lease with a small uptick for inflation, or CPI inflation or PPI inflation. But we're an inflation-adjusted asset, so we should love an inflationary environment. We have fixed rate nominal debt, meaning non-inflation adjusted debt, and our revenue line and our expense line, but primarily our revenue line, is inflation adjusted. So we are keeping up with inflation in our rent adjustments, or in some cases surpassing inflation by investing in the property, by doing renovations, by doing value add. And that's what enables us to really manage against a rising rate and potentially rising cap rate environment. They're not 100% correlated, right? You can have, base rates, say at the end of February, the 10-year treasury was trading around 170, 175 on a yield basis. Now it's trading just shy of 3%. So, that's a pretty substantial move in rates. And annoyingly, as anybody that's been trying to get a loan over the last month knows, it's not just rates that have gone higher, but also in many cases, credit spreads. So, the borrowing rate that's applied to that base rate has often gone wider as well. So the combination of higher base rates plus higher borrowing spreads has meant that your actual cost of borrowing may have gone up quite substantially, maybe as much as 150 or even 200 basis points. So 1.5 or 2% running, which is very, very sizable. But how do you manage out of that circumstance? You manage out of that by adding value. So I definitely would not want to be in an asset class where you're buying an already stabilized asset. Like that is a tough seat to be sitting in right now. What's helpful to us is that we're buying assets that might be 5 cap day one, but that we can push to 6.5 or 7 caps over 3 to 5 years through investment in the property, So actual renovations, amenity improvements, upgrading deferred maintenance, things like that. And then operational improvements, having a best-in-class operating team, on the ground, making a difference on a daily basis as well. But that's really the only protection that we can provide, is that value add component, because we can't control the market, right? There's no crystal ball. Now, I will say, I do think that a lot of, I think the inflationary concerns are overblown. I think they will be shorter term than a lot are expecting, and therefore the Fed, which has a dual mandate, a mandate both to control inflation, but also to help manage growth and ultimately employment, that they will, they're very growth focused. And I think, so some of the forecasting of radical rate increases in the short end probably won't come to fruition. And therefore the long end of the curve may duck down a little bit from where it is today.
I love that. I feel like we all need to go back and watch this. I actually just told my content team to make a short video of exactly this, because that was great. And it's just good information to have. Inflation adjusted assets. I think that is key. The 1 year rent adjustments, those are amazing. So thank you for that perspective. So what's next? Like, if you had to leave us with a thought, and we're still going to do audience Q&A, but if you had to leave us with a thought or an advice, what would that be?
I think, if you're building your own business, or frankly, anything that you're doing, I often get the question, what should I invest in, right? Yeah. My first answer to that is pay off overinflated costs of debt. So pay down your credit cards and invest in yourself. So what does invest in yourself means? It means invest in your education, invest in your business, because the highest return that you're going to get on any investment is going to be in yourself. It's combining your own capital with your own labor, and the two things matching to create the highest return. So that may be get a further degree that enables you to get a slightly better job. That may be as you start your own business. That may be as you invest in real estate and combine that with your own labor. So I think, in terms of best investments available, it's investing in yourself. And then, I'm always looking for the right risk adjusted return. Right. Know your risk tolerance, right? Know your place in life, know your income generation capability. How much income are you going to earn in the future? Are you at retirement? Are you just pre-retirement? Are you 50 years away from retirement? That makes a big difference in the way that you should invest. Yeah. But ultimately know your risk tolerance, and then look for deals that offer attractive risk-adjusted returns. There's no such thing as riskless. It doesn't exist. So it's just understanding what the risks are and making sure that you're being adequately compensated for those risks. That's what makes for a good investment.
Love it. I love the Ballast Rock website. I think there's such good information on there, just even in terms of your mission statement, and then just the way you guys analyze and hold properties. So I would encourage everybody to go on the Ballast Rock website and give it a look, because it's amazing. Thank you, Tom. Thank you so much for taking so much time out of your day. I do want to open it up to our audience. What questions do you guys have? I do have one question that was sent to me, and it is, are you focusing on environmentally sustainable development such as prefab or modular housing, or will you in the future?
It's a great question. And yes, that is something that in the future we will look at. At the moment, we don't do any real estate development. So, but we have looked and will continue to look for opportunities in sustainable investing. and sustainable architecture and modular homes. We don't currently have any offerings, but we're constantly amplifying our team. Ultimately, it's not my area of expertise, but what I think I've proven fairly competent at doing is finding talent, right? That's my job. My job is not to do everything. It is to find the talent that is capable of delivering those things in a scalable fashion. And so, yes, we are out there looking for that talent in that sector that will enable us to come on board and to build that skill set in-house and then launch funds related to that. Yes.
Awesome. If you guys have questions, raise your hand. Drew, go ahead.
This may be a kind of, I guess, base question in a sense, but it's been something I've been kind of struggling with, but it follows on with what you were just talking about. When it comes to finding that kind of exceptional talent, because I've been noticing in a lot of the different companies I've been either working with or working under, there's been a lot of struggle of actually finding that talent that's not just like someone who's really good at their job, but actually just an exceptional person to have on the team. Because you talked about a lot about your team and just the different people who are really, really good at what they do. Do you have any advice for finding those people, or is it kind of just as they come along your path, you grab them up when you can?
It has been mostly grabbing them up, grabbing talent as I've met it. I spend a lot of time networking in a variety of different locations, and I'm somewhat visible, so I do have people reach out to me direct. But generally, it is meeting talent along the way, right? I've been working for 20-something years now, and I've met a lot of people over the years, and I've been able to draw that talent in. And I think, so finding people is one part of your question. The other part is like, how do you actually bring them in? And the bringing them in part, it's my belief that I'd rather be a smaller part of a smaller owner of the pie, of a much larger pie, than own 100% of the pie. And so one of the things I've always tried to do is bring in partners or bring in talent that is energized by what we do as an organization, is energized by the flexibility of what we do, and also is motivated by compensation that is driven by their performance. And so it's a combination of things, and by participation in the upside of the organization that they help build. I've said to everyone that's worked for me, if you come in and join an existing business line, you'll be well compensated and you'll enjoy what you do. But if you come and help me build something new, then there's equity upside in that.
I love that. That's a great spot to be in.
That's awesome. Thank you.
Thank you, Drew.
Corey, go ahead.
Hey, Tom, thanks for talking. It's been great listening. I had a question. You're talking about like businesses that are doing environmental changes and things like that. Have you had anything with nuclear come across your desk in terms of helping with energy crisis in California and things like that?
I have not specifically, because obviously nuclear power is just like monster multi-billion massive projects that get entirely institutionally funded, and that sadly are extremely difficult to developing new nuclear power infrastructure is monstrously complicated from an environmental approval perspective, which for me personally is a little bit of a shame, because I do think that nuclear power has to be a critical part of our lower carbon energy transition process. It can't all just be solar and wind. They're
right.
Hydro, they're wonderful, and we need to invest in those things, but they're part of the solution, and nuclear is also part of the solution. And sadly, our friends in Germany right now are feeling the sharp end of some of the energy decisions that they've made as it pertains to nuclear over the past 20 years. And now they're overly tied to Russia as a result.
Thank you.
Mason has a good perspective on that too. And then I have another question that came through is, what do you think about triple net CRE over multifamily?
I'll admit, I've tried launching 2 triple net CRE funds over the last 3 years, one in 2019, which I wish I'd launched because we would have crushed it, because there was a huge rally there, but and then one last year. I mean, do you want my honest opinion, or do you? I really don't like that market. I think you're picking up pennies in front of a steamroller. You know, to use a trading expression that we used a lot at Goldman, you're entering, again, a lot of people have made a lot of money in that market, especially over the last few years as there's been a big rally. But you're taking these huge digital risks to your tenants that is completely out of your control. So let's say you've got a single triple net building. If that tenant goes under, you've got a long time when it could be dark. You've got TI that's very difficult to reserve for in advance. Your levels of leverage are low. You know, it's really for somebody that wants truly, absolutely hands-off income, and in many cases, I think doesn't always understand the risk. Again, it's, you know, it's just that, like, if one of my tenants leaves, so we have had at peak 5,500 units under management, about 12,000 residents at one point in time. You know, if one of my residents leave, I love them all, but if one of them leaves, we can replace them, and it's just part of a natural part of doing business, right? If your tenant leaves in a commercial property, it can be extremely problematic, and it's difficult to manage. So, just again, to speak about risk-adjusted returns, in my experience, in the stuff that we were able to acquire, and that may be very different to what others have been able to find, but in my experience, the math just didn't make sense. The only way it made sense was to be a triple net developer, so not to buy it in the secondary market. Secondary market is all bid up by 1031 buyers, so DSTs, Delaware Statutory Trusts. If you're not a DST, you probably shouldn't be playing in 1031. I mean, sorry, in triple net in the secondary market. But on the development side, it's different, right? You develop a building, you get it leased up, you flip it, and you sell it. Very, very different business model. That's just not what we do on the real estate side. We're buying secondary properties, no development risk, and upsizing them. So it's just it's a different animal. But yeah,
I'm really excited to hear that perspective, because Travis and I were looking at a bunch of triple net deals early last year, and ultimately I thought that those were all rich person deals. You know, when you have a lot of money that you want to park somewhere, you would go buy a triple net asset and then hopefully collect rent for as long as the lease is alive, and then you flip it to someone else. And then I was still so interested in that asset class that the way that I did it was bought a distressed office building, and now I'm rehabbing it, and then I'm going to flip it in a few years because I bought it for the location. So,
but you're not holding that for 20 years, right?
No, I'm not.
The other thing about triple net, like if you go out and you buy a Dollar General, right, and it's sitting in Idaho or something in the middle of, and so you buy this Dollar General, it's got a huge long lease on it, right? Yeah. Actually, as time goes by, there is what in options you would call time decay, right? The value of the property declines as you get closer and closer to the expiry of the lease.
Yeah,
right? That's the exact opposite of what a real estate investor really wants, right? What we do in multifamily is we buy a property, we pay 10 million, we invest 1.5 million, and we're going to turn that property into something that's worth
20 million,
15 million or 20 million, right? Like pretty sharpish, right? And we've used conservative leverage, but that means, you know, you're targeting 2x, 3x on equity. Our last fund, we're now at NAVs of about 2.5 to 3 times equity in 2.5 years. So that's, and again, historic performance is no guarantee of future returns, as any good broker will tell you. But I am Series 24, so I have to be careful about that. But those are, you know, those are realized returns. The last deals we just sold, we sold for 2.81x on equity. We just sold it like less than a month ago. So again, not doesn't guarantee, and genuinely, like everybody gives that disclaimer, but genuinely, we've just gone through one of the largest single rallies in multifamily in history in such a short period of time. So anyone that tells you that they're going to do exactly what they did in their last fund, in their next fund, is just stone cold lying to you.
Run away.
I'm not telling you that. I'm telling you, though, that we will create very, very attractive risk-adjusted returns. It's not going to be what we just did at 3x on equity necessarily, or it may be, but it will be over a longer period of time. It is unless we have another big rally, and that, weirdly enough, a lot of people say, what's going on? Rates are going higher, therefore all real estate will be less valuable. Definitely not true, because look at what else is going on in the market. You've got equities puking. Who wants to be long bonds right now, right? If the 10-year and the 30-year are going wider, that none of that stuff is good for your portfolio, right? So a lot of people are looking for assets. Where do they deploy capital? Where do they deploy capital? And what do they look for? They look for what's performed really well over the last couple of years that's not liquid. And that happens to be multifamily. That's one of the top performing asset classes in real estate over the last few years. And so they're plowing money into real estate, which is exemplified by, I wish I could pretend that it was my genius or my capacity to capital raise, but it's not. It's what's going on in the market. That's why we've got so much capital thrown at us. And I'm sure that's the case for many multifamily sponsors that may be on this call. But that means if you've got a lot of equity chasing not a lot of deals, that you're not going to see a huge widening, no matter what happens in rates, right? There's just too much capital chasing too few deals. So unclear to me that we're necessarily going to see a huge sell-off.
Let me tell you something, Tom. This is the longest I have interviewed a speaker on my platform. It's been an hour and 40 minutes, and I can continue to do this. So I'm going to give you a break, and I'm going to say thank you so much for really being here and taking all our questions and really having us be immersed in your business. Because like someone said in the chat to me directly, Tom is a beast, and I have to agree. But Tom, thanks again. This has been truly amazing. Truly amazing.
Thank you.
All right, guys, it's 4:00 and it blows my mind every single time that we actually spend 2 hours together, but it is the best 2 hours of my month. Hopefully it is the best 2 hours of your month. Thank you all for joining. Tom, thanks again for spending your time with us. I could have you right back here next week and we could have a whole other conversation. I know it.
Thank you so much. Enjoyed it. Really nice to meet all of you. Best of luck to everyone.
So I typically have one of my audience members take us away. And today, Josh Goldstein, take us out.
It was a great meetup as always. Thank you, everyone, and look forward to seeing you at the next one.
Bye, guys.
Bye.
Thanks so much, Leka.
Bye, everyone. Thank you.
Bye, guys.
Thanks
Bye.
so much,
Thank you.
Leka.
Cheers.
everyone.
Thank
Bye.
you.